Welcome to episode 2 of the Trader's Edge. I'm Jim Urio. As always, Bob Iacchino, the guy who looks like a mob enforcer, is the co-host and the brains behind the operation. And he's not anymore a mob enforcer, I don't think. Are you,
Not
Bob?
anymore. No, not anymore.
No. Good. Everyone paid up all their debts. All the kneecaps are healing fine.
To the point that I left, everybody's paid up.
Okay, good. Yeah, I don't know what happens now. Interesting week. And okay, so for you guys who watched last week, we've had a ton of fun with the show, and I think it's going to be really good. It's going to be, if you watch our Futures Edge podcast, this one's going to be geared more towards macroeconomics, filtered down to trading opportunities. We're going to talk about different asset classes. We're going to have guests. Today we don't have a guest. Starting next week, we will. Who are we going to have next week, Bobby?
Next week is Jim O'Shaughnessy, who's absolutely a legend. I mean, that guy
love Jim O'Shaughnessy.
Yeah. He's a legend. He'll be on next week. We've got him for at least 15 minutes, but he's committed to 30 if the show's good. So if we bore him to death, we've lost him after 15 minutes. Otherwise, he'll be here.
Okay, good. And that's called, I think, in the media world, that's called a tease for our next show. What it is? See, I'm getting to be a professional, aren't I?
Look at that. I don't know that I have that in me.
Okay, good. There are a lot of things that I want to hit today. I'm going to talk about stocks quite a bit. That's the thing that we trade the most, that most of us trade the most. Oil is the big mover today. Oil went what I thought was above some critical levels and then couldn't really hold them. At least they couldn't when I left the trading floor about 20 minutes ago. Bobby, what's the fundamental outlook on oil first?
So fundamentally, there's a couple of things going on. Number one, we're still in the midst of the summer driving season, but when you're looking at commodities, and obviously we're going to look at, we're going to talk about some of the names of which their stock price is heavily based on this commodity. But when you're looking at commodities, you have to take seasonality into account. And the seasonal effect of crude oil in the summer is that it kind of pauses toward the end of August. You have speculators involved in this market, and those speculators start to wind down their summer exposure. There are people that actually just trade seasonals. I think that's a silly strategy, quite frankly. But what we have going on here, though, is more focused on the supply side, not the demand side. The seasonal factors are often demand-based. And in this particular case, you're looking at a supply side issue here. Supply is there right now. The EIA said yesterday that U.S. production is going to be above 12 million barrels. Only 2 other times we've reached that level. But when you look at rig counts, okay, last time we had this kind of production, we were 37% higher in rigs. So more rigs were producing more oil. Now fewer rigs are producing fewer oil. That puts crude oil in a position, at least on the U.S. side of things, where when some of those oils stop producing, and shale oil wells are notorious for producing the vast majority of their production in the beginning of their life cycle, when those fall off, nothing to replace them.
Okay, so this is not a political show. We're traders. We don't really care about politics. We care about policy quite a bit, though, because oftentimes macroeconomic policy can affect markets greatly. When you say there's 37% less rigs, you said, why? Yep. Are there policies keeping for more rigs from coming online?
Well, first it was CapEx, right? And for those of you that don't know, CapEx is capital expenditures. A lot of these shale oil drillers were looking to return money to shareholders, not necessarily to overextend like they did in 2015-16 and then get crushed by OPEC increasing production and dropping prices. Well, now that they've actually started to spend on exploration, that's where the political problem comes into play. So, and I'm reading here from something from Rystad Energy, okay? Rystad Energy research shows that despite rising investment, okay, it's not the spec set one, guys. It's something I'm reading on the left here. Spending on conventional oil and gas exploration is rebounding. It's expected to top $50 billion this year. That's the highest since 2019. But operators are not getting the results they hope for. Again, this is according to Rystad Energy. Their research shows rising investment, but discovered volumes are falling to new lows. Now, why do I talk about that? Well, because they're focused on offshore exploration. Offshore exploration is not what this administration is going after. This administration has been going after shale drilling, which is onshore. Okay, offshore is traditional rigs. So if they find anything, those are going to have sort of more of a time release lifespan than shale rigs, which have it all at once in the beginning. Estimates, according to Rystad, showed in the first half of 2023, explorers found 2.6 billion barrels of oil equivalent, That's 42% lower than the first half of 2022, which was 4.5 billion BOE. That's barrels equivalent. 55 discoveries have been made compared to 80 in the first 6 months of last year. And this means that discoveries in 2023 are 56% lower than they were in all of 2022 when you extrapolate it out. And that is policy-based. Okay, that entire thing is policy-based. And that's because they're focusing on the offshore rather than the shale.
Okay, so tell me this, as long as we're talking about policy too. So I thought it was absolutely comical that we sold out most of the SPR over the last 3 years. Okay,
Yeah.
Now we did so. This is my theory. And again, Bobby's forgotten more about oil than I know. And by the way, so those of you who are just tuning in, who are unfamiliar with us, Bobby can't talk about every asset as eloquently as he can talk about oil. So he's not, he's not a genius, but he's got some pockets of knowledge that I stop and listen. But anyway, that's a little bit disclaimer for our show. So it was ridiculous to me that they sold the SPR, which there didn't really seem to be a reason to, and they continue to do so. Yeah. Is there a chance, this is what worries me the most, is if it starts to run it, WTI, I think if it closes above, call it 84, 84 and a half, which it's flirting with those levels right now. If it closes above there on a daily basis, I think we're somewhat off to the races. Is there a chance that those countries that hated the fact that we were depressing the price of oil when that's what they sell, talking about the OPEC countries, that they tighten the screws and start cutting production at the same time we start thinking about restocking the SPR?
Yes, I'd say it's at least 50-50, and that's a high chance. So you look at it from that perspective, they've already decided to extend the production cuts that were announced in June through September. Saudi Arabia announced it, representing OPEC. Russia announced it, representing the plus part of OPEC plus. So yes, but even if they just extend the production cuts and just wait for shale to dry out, same issue, just longer scale.
So this could be a sizable move. What do you think the trade is?
Could be really bad. I think the trade is to 91. Okay, I think the trade is to 91. And the reason I say that is because, Jimmy, you know this. The way that I trade, and Jimmy does to a certain degree as well, is we have targets for where our trades want to go. And the reason is we want to take profits, right? That's the point of trading, is converting that trade into money, right? I don't care what the computer says I have if I don't actually have it. When I search out targets, I look for places that I think the market's going to have a very easy time reaching. And then I compare that to my stop, which I want my stop to be a place where the market's going to have a very hard time breaking through to get to. So an easy target is 91. I think a hard target is 96. I think could actually get to 96. But I see 91 in the cards if we get that settlement you're talking about.
So we had kind of a partial breakout today, but then we started to fail a little bit. Again, I haven't looked at it in the last 25 minutes. If we have a poor day today or tomorrow, do you think it's a fake break and perhaps the move is not afoot?
I want to see that same close you're looking for on a weekly basis, not a daily basis. Okay. And the reason I say that is because we've been in this particular sideways channel going all the way back to, let me just make sure I'm right on this. We're talking August of last year. We've been in this channel since. So breaking out of the defining point of that channel, I'd like to see on a weekly basis more than a daily basis.
Okay, now let's bring it again. What you're going to notice on our show is I'm long the oil names, and I plan on increasing the oil names. My licensing, I'm a futures trader from way back. My licensing is more to talk about macro, to talk about futures contract. I don't give recommendations in individual stocks. I do give not recommendations. I do talk about what I'm doing in specific sectors, and I'm planning on increasing my exposure to the oil names that are highly correlated with the price of oil. I think I know what Bobby's response is going to be. If you want to be long oil, be long oil. But do you look at the names? Do you like any of the names as well?
I do. I like Exxon and I like Occidental Petroleum. So Exxon broke out today along with the breakout that you realized and you looked at today in crude. So that, first of all, that kind of reinforces what you said is a breakout, that it is a breakout, it's not just you and I saying it. It's a bunch of people buying Exxon. So Exxon broke out above its 200 today. I want to see if that's a head fake or if that's going to sustain. Occidental Petroleum already broke out, did a head fake, went back down, broke out again, tested, and that breakout held. So my favorite one of these is OXY, Occidental Petroleum.
Tell me this, the names have always traded with a very high correlation to the underlying, to crude.
Mhm.
Is that fair, or is just one of those things where the market says it's so and it's so? Do they make money as the price of crude goes higher substantially?
They do. The reason that I always sort of defer to the actual asset, whether it's a USO or whether it's the actual crude oil futures contract. By the way, USO as an ETF it underperforms the futures asset dramatically, and that has to do with rolls and
Roll.
things like
Yeah.
that. Um, but from a perspective of the names themselves, I lean toward the commodity because it doesn't have CEO scandals. It doesn't have things like, non-GAAP earnings. It doesn't have one-time charge-off because of an acquisition they made, right? If crude oil is going up and you believe crude oil is going up, it's going up, right?
But the ETF
If
of
you're
the
right about it.
names would smooth out some of those things as well, right?
They would. I mean, the names would smooth out the downdraft. So like something like an Exxon or an Oxy they could cut costs somewhere. So while
Right.
crude oil goes down, their profitability stays up. So that's
So
why
no,
when I
I
have an
meant
opinion on,
yeah, I
go
meant the
ahead.
ETF that packages them all together. I can't
Yeah,
remember what it is right now.
yeah,
What is it?
yeah,
XL
definitely.
XL what? Uh,
USO. Oh,
USO is the
you're talking
oil.
about XLE.
XLE, boom, yeah,
Yeah,
the
the energy
ETF that
ETF.
has all of
Yeah.
them packages. Right. Yeah, I think I have some of that as well. So, anyway, you want to move on to stocks? I think it's
Yeah, we
incredibly
actually have
interesting.
a crude oil question in the comments.
Oh,
So I'd like to get to that if we could.
love it.
Um, it says, what do you think the motivation is behind Saudi production cuts? I
I think
mean, I
it's
think they're
stick it
mad.
to us.
Yeah, go ahead, Jimmy. I think they're mad. Go ahead. It's the same
I
thing.
think okay, let's put it this way: is if back when we started selling the SPR intentionally to depress the price of oil going into a extremely important election, right? The midterms. Um, if Saudi, that's what they sell. If somebody I sell in my restaurant, I sell burgers and ribs. If someone was intentionally depressing the price of burgers and ribs and cutting my margin, I'd be irritated and I'd have an X to grind. And I think they do. That's why I bring up all the time. I think if it starts to run and if they get a whiff, that we have to restock the SPR, which by the way, Bobby and I have been in trading pits for each of us about 35 years. If somebody knows that somebody has to buy or has to sell, the world gets very exciting because all of a sudden everybody starts to front run them. And is it fair? Is it ethical? I don't care. We don't think about that stuff. If we
Yeah.
know somebody's caught in the jaws, it's not our job to let them out. I think that the Saudis are going to think that way too. Bob, do you agree?
I totally agree. And I also think the Saudis are kind of anti this administration. And again, I'm not talking politically here at all. I'm not saying they were,
Policy.
yeah, I'm not saying they were pro-Trump, but they're so focused on renewables. I mean, personally, I don't believe the actual source of energy is why they do this, but now I'm getting political. But from a perspective of what they're focused on the world destroying Saudi Arabia's economy. If you want to actually boil it down to the way Saudi Arabia sees it.
Yeah.
So I don't see why they wouldn't kind of put the point forward that, look, the world needs carbon. There's not a whole lot you can do about it. There's not a better way to do it than to help crude oil prices go higher.
Amen. Okay, let's move on to equities.
Yeah, can we do a quick? So since we're talking about oil, I just wanted to mention something. We got CPI tomorrow, right? So this is a live show, so we can get away with this, and then people can watch the replay and see if we're right, wrong, and different or what. So CPI tomorrow is expected. Let me just read the expectations off on something I've got on the left of the screen here. Core CPI year over year is expected to be up 4.8. It was up 4.8 last time. Inflation year over year, that's the headline, 3.3 versus a previous 3%. I suspect that's the 15.8% effect of the increase in crude oil in July. So July crude oil prices were up 15.8%. Core inflation is ex food and energy. So headline inflation includes food and energy. So we would expect that some of that increase over last month, year over year, would be that. But the month over month inflation rate, they've got unchanged, which is interesting to me. The estimates are for 0.2. The last was 0.2. And then the core also 0.2 versus 0.2. I think they might be wrong on the headline figures simply because of the run we had in crude oil. Now we know this is July CPI. I will point this out. If the July CPI is as expected or lower, then that likely means that the servicing period didn't catch the entire crude oil move, right?
Okay.
That's likely what that means. And that means you're probably going to see it built in to the next set of CPI figures.
What about base effect?
Base effect started last month, right? So, and it's actually going to hit pretty hard this month. If you go in base effect, for anyone that knows, when you're looking at year, or doesn't know, I should say, when you're looking at year over year, you're going versus last year's number. And we started to see a decline last year in June. So
Right,
now
this
June
time,
and
yeah.
July is when we're going to see the effect of the difference of, well, you're starting to compare it to numbers that are actually more comparable to these numbers. So you could see a little bit of basing in the CPI figures based off of base effects. I'm supposed to get better at that, not mention the
Yeah.
same word over and over again.
Based off of base effects, it's not. Yeah, that's what
Yeah,
they're
basing
literary
is
tool.
basing it off of basing that.
Okay, so let's cut down to it. Okay, my contention is with CPI, with inflation in general, is that the efficacy of these rate hikes has not been fully felt yet. If you guys, I wrote a Substack about this last week. My belief is that the 5 years that preceded the first rate hike, 10-year yields traded at an average of 1.96%. To put that in perspective, since 1980, the average 10-year yields, I'm getting somewhere with this too, by the way, so hopefully some people don't take a nap in between it, average about 5.7% for 10-year yields for the last 45, 50 years, whatever. The point I'm trying to make is this. Small business, medium-sized business, retail, for car loans, mortgages, people had ample time to roll into duration and get long-term loans. This is a little bit of a different tightening cycle than other tightening cycles in that the rates are going up, but there's plenty of people sitting on the sideline going, oh, thank God I got that 3% mortgage. There's businesses that saying, thank God I got that 3% 5-year, 7-year business loan. This hiking cycle, because of that, is going to take longer to hit. My point being is that the fall in inflation that we've seen, my contention is that from supply chains healing, from the federal government no longer injecting money directly into people's accounts, they're still doing stupid inflationary things, just not as stupid as inflationary as they were before. Do you think that has validity?
I do. I mean, when I look at what's going on now, let's sort of roll into equities from this particular part of the conversation, right? Inflation.
We're getting so professional.
The Inflation Reduction Act was a spending bill. Okay. So again, it's not a political statement. When you inject money, whether it's fiscal policy or monetary policy, of course, being the Fed, fiscal policy being the federal government. When you inject money into an inflationary scenario, you're not helping inflation to fall. So that's part of it as well, right? They're not, when you say they're doing stupid things, they're not necessarily putting it in your account anymore, but they're putting in the account of some businesses, handpicked, of course, that are then putting it back into the economy, causing inflation to not come down as much as it would have without this. And here's why I think that's valid. And here's my fear now. My fear this entire time has been that inflation won't come down fast enough to be gone when the recession comes. Again, I'm still a recession person. These people who think we're going to have a soft landing or no landing don't understand how inept I think the Fed is. Right. And I know you're in that camp as well.
Amen. Yeah.
So, assuming that they've somehow, with the help of this particular administration, engineered a soft landing, I think is naive at best, silly at worst. From that perspective, when you see all of these different aspects of money still going into the economy, definitely it's going to slow the actual natural business cycle from playing out the way it should.
Yeah, that makes perfect sense to me. Okay, so that segues us into the stock market because our good friend Cameron Dawson, who's going to be our guest on this show in 2 weeks, and if you guys have never heard her speak before, she's eloquent. She's unbelievably eloquent. She knows her shit. Okay, her latest note, she talked about the positives and negatives of the stock market. She said the negative side is potential recession, profits recession, a lot of forward guidance that is coming in worse, despite the fact there's a lot of beats during this earnings season. But beats during earnings seasons are a dime a dozen. They lower expectations. It's a bit of a rigged game in earnings season. So that's the negative side of stocks. The positive side of stocks is that, let's call it an extra $2.5 trillion that's still in the economy based on the COVID measures that were pumped into the economy. And some of it's been sucked up and not all of it. A belief that the Fed is going to ease next year. Now, Bobby and I have disagreed about this before. He thinks it's higher for longer. I do think there's an ease next year. And I just point out, and this is not an any sort of gotcha, that the Fed funds market and the yield curve, they agree with me, and that's why I
They do.
have that opinion. But she
They
also
do.
talked about sentiment and buying begets buying, selling begets selling. That part has seemed to be pulled out. The S&Ps broke through 4,500, which I believe was a big deal, but now we keep flirting around it. I think the correction is afoot. I want the correction to be here, not just for the fact that I'm short, well, long a bunch of puts, but also for the fact that I believe that a stock market rally becomes healthier with a good 5 to 10% correction, pruning. I haven't got it in several days. Am I going to get it, Bobby?
I don't know. I'm looking at the NASDAQ to my left, and we are so far away from we're working on the second consecutive week lower, and we're so far away from it being troubling at all in terms of the depth of the down move. I would also like to see the correction happen. I still technically don't call this a new bull market, because how are we in a new bull market if we haven't exceeded the highs of the old bull market? We've just never understood that. But
well, yeah, but by that thinking, then you sometimes can miss, a huge move off the lows, right?
well, that means you need to buy during a bull market, and I don't believe that at its core. I've been trading this market long.
Sure, I got you. I know.
I mean, going off on a different tangent here, why do we have to name things in the first place?
I
Like people
agree
say,
completely.
yeah, I mean, for example, a recession. If you look back at every recession for going back to 1940, stocks rallied from the beginning of the recession to the end of it, except for two. And in both those instances, inflation was present. And that's what worries me from a stock market perspective, is
Sure.
that if we disagree on what the Fed may do, I will switch into your camp. Okay. If what we talked to Stephanie Pomboy when we recorded our podcast with her yesterday, if what she says she's worried about comes to fruition, and that's the refinancing. So if we get to the point where all of this corporate debt and all this other debt needs to be refinanced at near double rates, the Fed will have to cut, because that would be too much of an axe to the current economy as well as to equities, right? So
Can I connect a couple dots for people
yeah,
real quick?
please go.
Because something you said that I need some dots connected. When he said the recession stocks rally except for inflation, because when we go into recession and there isn't inflation present, the Fed has free reign to inject liquidity, cut rates. The times where we've gone into recession and there has still been inflation, particularly back like in the 70s when cost push inflation came from energy, which we just outlined is quite possible this time, then stocks have a difficult time because there's no white knight coming to the rescue. That's all I wanted to make sure people were following you on that.
In the current economy, yes. But if we go back to 1940, there were plenty of recessions where the Fed didn't necessarily intervene in such a visible way, right?
Oh, right.
It's
Good
because
point. Yeah.
Inflation is a tax on growth, period, right? And especially on middle class on down, inflation is a tax. If you're middle class on down, and I would argue even at whatever level you and I are at, which is really nobody's business, inflation sucks. You spend more money on fewer goods because you can't afford as much as you used to. So it's a tax. And it's just like raising taxes during a growth spurt. And then all of a sudden growth dies down because the taxes have gone up. People have less to spend. So yes, but during this particular time, yes, it's going to be because the Fed can't necessarily swoop in with the sort of verve that they could have in the past.
Right.
Now, I literally can see the NASDAQ go down 10% from here before it worries me in terms of the overall move, right? Simply because the breakout has been so strong. So now people are going to be like, well, you're a knucklehead. This isn't a bull market yet. We can drop 10% and you're going to call it a correction. Yeah, you're right. Overall, I'm a knucklehead in this.
Yeah.
And to your point about earnings, I'm going to put something up on the screen now. And it's a note from FactSet. I'm going to read from this thing. And I think this talks a lot about your points. The headline is S&P companies see largest negative price reaction to positive EPS surprises since 2011. And as I read this, Jimmy, tell me if you think earnings per share is going to get better or worse in the future if inflation is present. To date, and this is, of course, thank you. That's a perfect answer. Yeah. This is as of August 7th, right? And today's August what, 9th? Yeah. So to date, 84% of the S&P of the companies in the S&P 500 S&P 500 have reported earnings for the second quarter. Of these companies, 79% have reported EPS above mean EPS estimate, which is above the 5-year average, which is 77% of those companies, and above the 10-year average, 73% of those companies. So that's good, right? EPS beats have been higher than the 5-year average and the 10-year average. In aggregate, earnings have exceeded estimates by 7.2%, which is below the 5-year average, not so great, but above the 10-year average. I'm going to skip down now. Given this strong performance relative to the 10-year average, how has the market responded to positive EPS surprises? Now I'm going to jump down to the chart here, right? I wonder if I can expand this chart. I can probably do it. I don't know if this expanded on your screen, but expanded on
it did. Yeah.
Okay, that is pretty cool. All right.
Yeah.
Now, the market is currently punishing positive EPS surprises. If I go down to here, companies that have reported positive earnings surprises for Q2 have seen an average price decrease of 0.5% 2 days before the earnings release through 2 days after the earnings release. And here's the chart that reflects that. Whereas positive EPS and negative EPS, you're getting a drop in their actual price. All right. You have the same thing here in this particular chart. Positive EPS surprises, average price change over the last 5 years. Look at that, down 0.5%, 2 days prior and 2 days after. Okay. Now that particular thing worries me for how bad stocks can become if we haven't, or stocks can react, I should say, if we have a situation where inflation is present during a slowdown in the overall economy because they're already reacting poorly. But this is completely hidden by how well equities have done since basically, I don't know what, January?
Yeah, I think it kind of started in October.
Stocks are starting to be punished by positive earnings surprises.
By the way, so that stat to me is enough for me to be emboldened with my correction call and to lay out the correction. I've been preaching about this for about the last month up until about 2 weeks ago. The VIX options were being given away, in my opinion. Options were cheap as hell. The VIX was trading at about 13.5 with historically low levels. I know we've seen levels like that before, but they match somewhat historically low levels. Every time we had an update in the S&P, I would put on an option structure. What I favored was selling a put that was about 5% out of the market to buy 3 puts that were about 8% of the market. Now it was getting to be an uncomfortable, and it was a hedge position against my longs because I thought it's so cheap to hedge your longs. But then it got to a size where I'm almost like, oh crap, if all of a sudden we have a sharp downturn, I'm going to make some decent money because not only is vol going to go up, but skew is going to go up too, was my thinking too. And skew being the skew smile where the further out options will do better and increase prices. And I own a lot of the further out options. I know you like to trade. I was just explaining it to some of the people too. I mean, only because you've told me before. And so I'm just, the stat you just gave, that's fine for me. I think the correction takes us to an initial spot of 4,400 in the S&P, which would be about 5%. But I really believe in the closer to 10% correction would be the 4,200. When you look at the charts, do you think those levels make sense?
They do. They make a lot of sense, especially when you look at the levels that I just stated. Like, for example, the NASDAQ can go down over 10% before I worry about the overall up move that we've experienced this year. The S&P, it's only 5%. So, and that leads me to a question I have had for you that I've wanted to ask you, and I guess I'll save it for the show. Do you think the VIX is broken? Just as an indicator, they continue to call it the scare index. Do you think it's broken as the quote unquote scare index?
Yes, I think it's lost some efficacy too. And the trading of options, I think, has obfuscated some of the message that it gives, that just the fact that options have exploded, particularly the options that retail traders trade now, I think can blow it out to different levels. I think the term structure of the VIX, which I don't want to go into, makes it a little bit, actually Scott Nation has a product called Baldex, which I think is a better measure. But to the overarching point you're asking is that people will be like, oh, the VIX is at 30 or 40. There's fear in the market. That's a sell indicator. I don't see it that way at all. What I see is if there is periods of time with extremely low options volatility, I think to me it means that people are not respecting risk the way the talking heads on TV saying like, oh, the fear index is low, so there's nothing to worry about. No, that's to me when it is something to worry about. I believe I did this work before. I think almost every one of the biggest corrections we've seen, the biggest vol spikes we've seen, and again, please don't quote me on any of these numbers, just the general idea of it, it comes from very depressed levels of VIX. Like, it's rare that if we traded 30 VIX for 6 months, then all of a sudden we're going to have a big VIX explosion. It usually doesn't happen that way. The big VIX explosions, which correspond with big down moves in the stocks, correspond with low levels for a long time of VIX. That's why I thought this 13.5 was a perfect. Did I lose sight of the answer to that question, or did I answer it effectively?
No, not at all. I mean, I think, one of the things that I've noticed lately is that the VIX seems to lag.
Yeah.
I mean, the moves kind of happen and then the VIX rallies and people are almost looking at it like, well, the VIX is up now, so this move must be real. And
That's funny
I
because it
don't see
happened at
that way at all.
the beginning of this correction. The first couple significant down days, the VIX barely budged, and I was like,
Yeah.
"What the hell? This is where I'm supposed to make my money right now." And I made a little, but then it started to move. Right?
And correct me if you think I'm wrong on this. What people used to think was, I mean, the VIX used to move because people were scared and they started to buy insurance, which moved the volatility up, which moved the VIX. And now we're not seeing that. To your point, the worry about the fear in the market just isn't there. When you're looking at, people like you mentioned a couple of weeks ago, unfortunately, we hadn't started this show yet. You mentioned a couple of weeks ago the insurance was cheap. And that's part of the reason you were starting to look at these trades. And actually, we've got a question about your trade. I don't want to screw up this person's name, so I'll just call you Max. Could you expand a little bit more on your 1 short to 3 long put strategy? What would you do if the market keeps going up when you get close to expiration?
Well, you're going to if the market keeps going up and all of them are out of the money, you're going to lose your money because you're going to pay for this. So let me explain it. I don't know exactly what the strikes are, but let's just look. This is an example. Let's use the SPY because that's something you guys are familiar with. The traders, like if I sold like 1 440 put, and I have it out to mid to late October is the expiration on them, to buy like 3 either 420s, 410s, or 400 puts. I have different levels, different structures on, and I don't know exactly what they are now. So you pay for that. You are definitely buying a negative delta structure, even though you're selling a put. And I sell a put just because even though volatility is cheap, it always makes me feel better if I think I have a clever, cute way to finance some of the trade. And at the time, the 440 puts, we were at 46. I think was about 5% under the market when I was doing it. Again, I'm not sure of any of the exact levels of the trade I have on, but because I layered it in over weeks. So the theory is that as we start moving lower, volatility pops higher, which it didn't at first, but now it has a little bit. So those 3, I'm long, let's say 30 to 10. Those 3 will start to outperform. The 30 will outperform the 10. And then as we go to a real panicked position, then those out of the money puts will start to perform even better than they should based on the skew blowing out. There's something that I want to bounce off of you now too, because you said we're not seeing the same level of panic on some of these initial moves. I might be reaching from left field, or we might be hatching a brilliant theory on the Trader's Edge podcast. Is it possible, because so many retail traders, and the options volumes back this up, are trading options? If you're holding the underlying SPY, there's a certain level of panic because your losses are unlimited. But if you're long a put, if you're long a put spread, or you have well defined your risk with, or long a call spread, whatever you want to be long the market, and you're just going to lose what you paid for that, there is by nature less panic if you know that your losses are defined and limited. Does that make any sense?
Yeah, that number one, that's true. Number 2, especially because most retail traders, I shouldn't say most, but a lot of real retail traders are doing the weeklies.
Yeah.
So the weeklies have so much less premium in them and so much less time to expiration. They don't even worry about it. It's almost like a lot of retail traders are buying lottery tickets just anywhere they can find them.
Right. If they lose it, they're not in a panic. They just lost.
They lose. But real quick, Max, I think, was really concerned about like the risk on that trade. So can you explain whether that's defined, not necessarily how it profits, but where your risk falls in on it?
Risk is much more important. So let's say that I sold that 440. Again, I'm making random numbers. This is not the extra trade. I sold that 440 for, let's call it $3, and the 410s were all like, let's call it 180. So 3 times 180 is 360, is like 540. So $3. So I would have spent $2.40 for that trade, or $240 for each one lot in the SPY, if that's what you guys trade. If the market rallies, I just lose what I paid. But the risk, the real risk is that, and one of the reasons I have it out to October, because if you had something like this on where you were close to expiration, and I've had this happen to me before, and it absolutely bit me in the ass, where the market all of a sudden goes down through that top put. So you are now short at that top put, but doesn't make it down to those bottom puts where you can start making money on it, and you can lose the difference. By the way, I'm not having this trade on when it gets even a month close to expiration, because I won't, because that's where the real risk happens. So you got to monitor deltas on this. And if the delta is not still negatively correlated, or starts to lessen that, you got to get out of that before you can get caught in that gap. Because you can, for each one lot, you can lose 30 ticks from 440 to 410, and that can leave a mark. Did I explain that well enough, Bobby? Be honest.
Yeah, you did. And this is part of why you like doing the ratios, right? Because you like to finance a little bit of the trade.
Right.
And you obviously think you're right, and you have sort of a time frame in your mind. But if you're doing just one-to-ones, which would be limited risk, right? You end up with, because of the low volatility that's perceived in some of these options, it's a very hard time for you to do that, where you're selling a put, buying a put, and actually time that out.
Right. But since I'm long more than I'm short, technically my risk is defined. It's the difference between the top strike and the bottom strike that I own. But that's still a lot of risk when they're as wide as that trade is. Too much risk for me. That's why I'll be out of it in a week.
Yeah, one of the things you guys will find about Jimmy's position, and since this is a weekly show, he'll tell you when he's out of it, is that he doesn't hold these things to expiration. So I think it's very rare that I've ever seen you hold one to expiration when we talk about your trades. He's usually out way before it. So the question was, what if the market keeps going up when you get close to expiration? He'll be talking about a different trade at that point.
And if I had this on expiration and the market kept going higher, it would be no worry, because all of them would just be declining, and I would just lose what I paid for the trade. The problem is when the market breaks close to expiration and I lose money on one and not make money on the other.
Let's move on to interest rates real quick, because I want to talk about something that actually somebody mentioned to me on the side, is that they didn't know what we were talking about with the yield curve. Okay. So I want to talk about that real quick, because it's very important to know what the inverted yield curve is. Max, by the way, if we didn't answer that, feel free to throw a follow-up in there. But the yield curve itself, and Jimmy is as eloquent with interest rates as I am with crude oil, so I just want to introduce this. Talk about the yield curve itself is when you plot yields on a graph, okay, and you plot them by duration. And what I mean by duration, we all know that there's a 3-month T-bill, right? We all know that there is a U.S. 2-year note and a U.S. 5-year note and a U.S. 10-year note and a U.S. 30-year bond. Those time frames that I mentioned and associated with the name of those assets, those represent the duration, the amount of time to what's the word I'm looking for? Maturity for those particular bonds. So if you were to plot the yield on those, okay, you're plotting a curve. All right. So a normal curve has a lower interest rate on a T-bill, for example, a slightly higher on a 3-month bill, slightly higher on a 2-year note, slightly higher on a 5-year note, etc. That's the yield curve. Okay. So when we talk about a steep yield curve, and I don't really know which way you guys are seeing me, but if we talk about a steep yield curve, you're talking about the 3-month here, the 2-year here, the 5-year here, the 10-year, and the 30-year, and that's steep. Now, when the yields on the longer duration assets, the longer dated assets, start to fall, and though these either rise or don't fall as quickly, you start to get what's called flattening of the yield curve. Now, inversion. You want to cover that, Jimmy?
Sure. And so remember, the basic principle here is, in normal times and a normal sloping yield curve, you expect to get more money to make up for tying your money up for longer duration. So remember that. So as soon as now we go into inversion, where the yield on the 3-month and the yield on the 2-year is higher than the yield on the 10-year, well, obviously, even a novice will look at that and say something's messed up. Something is economically not functioning, where in a normal situation, you can lend money to the government for 3 months and they'll pay you much more than if you lend money to them for 10 years. And remember, it's not the government deciding where those instruments trade. It's the market saying that. So if what the yield curve was 100 from 2s to 10s was 100 basis points inverted a couple of weeks ago. So that means, let's just say for argument's sake that the 2-year was trading at 5%. You can invest in a 2-year treasury bill and get 5%. The 10-year was trading at only 4%, a full 100 basis points or 1 full percentage point lower, meaning you could tie your money up for 10% and all they were going to give you was less money than they were going to give you per annum than the 2-year. What this suggests, it's usually a precursor to a recession because it smacks of one, panicked money that might be going in for a longer time into longer term duration treasuries just to park there, rolled up. But it's also an estimate on where inflation is going to be. And that market is telling us that inflation is going to be lower. Now, one of the reasons that it's a big precursor to inflation, I think it's called almost the yield curve is inverted prior to almost every recession before 1920 or since 1920, except for one, right? And it usually happens between 6 to 24 months. The recession happens after the yield curve inverts, which, by the way, thanks for the help. 6 to 24 months. It's long. Obviously, it's a big ass window. But let's just say the average is 15 months, which we are not quite there yet. It's July, so we have a couple more months before we're at 15 months that the recession, based on historical predictions from that yield curve, is set to occur. Me being an interest rate guy from way back, when the yield curve screams at me that a recession's coming, I still believe it. And I think it's coming within the next 2 quarters. Is that an adequate explanation, Robert?
It is. So when we talk about the yield curve inversion, a lot of people look at the 2-year versus the 10-year. Some people look at the 3-month, 30-year. There's a bunch of different yield curves that people look at for different reasons. And when the yield curve is inverted, one of the signals that the research that we've done is that the yield curve starts to, let's call it normalize, because we know the conversation we had, and I agree with you on this, that steepening versus flattening isn't really representative of what's physically happening in your view. But when the yield curve starts to normalize, okay, that's generally a signal that the recession may be beginning soon, not that it's already begun. Okay, generally the depth of the recession, the yield curve is normalized months ago. And that's usually because economic data has started to collapse, and either one of two things: people have started to spend less and the Fed has started to cut rates, or people have started to spend less and rates have naturally dropped on the front end, simply to encourage lending from banks, credit cards, et cetera. So let's just stick with the Fed has started to cut rates, because that's what's happened basically.
Fed's in a panic and they have to bring rates down quickly.
So they cut rates. Yeah. So when we talk about a yield curve normalizing or going back to its normal point of steepness, some of the things you should be looking at that point is financials. Because banks, a lot of people don't know this, but banks borrow short and lend long. And what that means is they borrow from the Federal Reserve overnight, and then they make 10 to 30-year loans, and they collect a higher interest rate off of that. So people don't understand. It's like, what do you mean they lend long and they borrow from the Fed overnight? Well, they lend your money out to somebody else. And that's why if you go to get all your money and you have a lot of it, they don't necessarily have it. That's why runs on banks cause problems. And the Federal Reserve makes them have a certain amount of the money they've lent out, or the money that bank represents, in that bank overnight. So they just go borrow it from the Fed overnight, pay a tiny interest rate, then they pay it back in the morning and they don't have your money, right? So banks make a lot of money when the yield curve is normalized. And that's why sometimes financials tend to lead us out of recessions. So that's the kind of thing, and I wanted to talk about that. So based on that, the yield curve is going in the opposite direction today. Does that bother you at all?
So where's 2s 10s now?
2s 10s went from a low settlement of, I believe, -64. I keep track of this on a spreadsheet. I can put this up on the screen so we can kind of scroll around and talk about it. But it's going to take me a second to share the screen. It's sitting at about -75 the last time I sort of justified it, so to speak. It's been as low as, let me put this up. Let's see, share screen. I will get better at this, just so everybody knows.
Oh, and you're asking me the question because a week ago, I thought the trade was going to be the steepener or the return to
Yeah,
normalcy of the curve.
kind of
And
why I'm
at the
bringing it
time
up.
I said it the first time, we were at like negative 90 and we shot up to negative 64. By the way, I
Which is
didn't have that.
great.
I never, and I was clear on Twitter, I never put that trade on because by the time I got around to it the next day, the move was already, I felt like I was chasing. It already moved
Yeah.
kind of very fast the next day. You expect me to read that with my old man eyes? Jesus Christ.
You could see this though, right?
I could see that it's a chart. I mean, a table. Right?
All right. So I'll zoom in on this then. Okay. Did this
Yeah.
just zoom?
Yeah, you're zooming.
All right. So column L here is the twos,
Twos,
tens.
tens. Okay, good.
All right. So it's negative 75. It's gotten as low as these are settlements. It's gotten
Right.
as low as a negative 67 settle, which happened in row 549. I don't know what the date on that is.
Right.
Let's see.
He means a
549.
high of negative
Yeah,
67.
549
Yes.
is August 7th. Yeah, you're right.
Yeah.
So it would be a high of negative 67. If I scroll back to get to where the yield curve was normalized on the twos, tens, okay, and I do this every single day. Here we go. The last time that it was positive or normal would have been row 275. Now I got to see what I got to roll over because of your old eyes. That would have been July 1st of 2022. And that was
Right.
positive 4. That's not normal, by the way, +4. That's not a normal curve. But you're talking essentially over a year ago, the last time that this thing was positive.
And twos versus tens is not the best way to look at the yield curve. Twos versus tens is by far the most common way to look at the yield curve because for the last 70 years, the CBOT's most heavily traded instruments are 30s, 10s, and twos. Realistically, nobody trades 3-month T-bills. They trade 3-month Eurodollar and SOFR. But all the big traders, if they were going to execute big trades, would kind of by necessity go to twos versus tens because those were the futures contract. Those were the most liquid. That's a reasonable explanation.
Yeah, which one do you like? I don't know if I've
3-month versus 10-year, I think, is a little better. Do you have that up there?
So I don't follow that one closely. I have 3-month 30-year here. And
yeah, sure. That one is a good one too.
You've actually got it was normal, so to speak, for a much longer period of time.
Right.
It actually went back to positive here. So that's row 365. So the last time, now this is, I mean, if you guys think about this, that was November 9th of last year. Now I'm going to stop sharing this. Yeah. If you think about this, the last time that the 30-year yielded more than the 3-month. Now, if you people keep in mind that basically represents the yield you would get for lending your money to the government. Okay. That's what that represents. You could actually lend your money for 3 months and get a higher yield than you could lending it for 30 years.
And by the way, if you guys are out there thinking that this is a boring conversation, no, this is not boring. This is a big deal. The fact that he just said they're going to pay you more for 3 months than for 30 years, like that is a cataclysmic set of circumstances. And yeah, so it's pretty amazing. But can we move on to a couple different assets before we cut it here? Because
let's pick up this question first that we've got here. It's, MM79. Besides a reduction in GDP, what do you see as the main effect of a recession for the general public, and how would inflation move if a recession does occur?
You want it or you want me?
It's jobs.
Jobs, of course, right? And Jay Powell, when he puts up and he says he wants slack in the labor market, what he means is he wants you and your family to lose their jobs. It's a very, very cruel thing for the government to be messing with people's livelihood, but that's exactly what it is. He needs to see, one of the reasons he's raising rates is to create slack in the job market, meaning an unemployment rate of about 4%. It's awful when you think about it, but that's what it is. And yeah, there's a lot of suffering that happens when recessions are. Now, hopefully they want a mild recession and a soft landing. You agree, Bobby, that they want a mild recession?
Yeah, I do. I
think they were terrified of inflation running the way it was. So now the problem is, as Bobby and I both see it, is that when they get their mild recession, all of a sudden input costs like crude are going to keep inflation high, and they won't be able to lower rates back down again, so where companies could borrow and expand and hire more people because they're caught between a rock and a hard place. So this could be awful.
And you extrapolate that out to the second part of the question, how would inflation react? Well, hopefully inflation then drops because there are fewer people with jobs. This is what the Fed wants. Fewer people with jobs, therefore they're spending less. Therefore, the amount of money chased. Remember, inflation, as best defined, I think, by Milton Friedman, is too much money chasing too few goods. So the price of those goods go up. So therefore, if you don't have a job, you spend less, and therefore the price of things goes down because there's fewer people chasing those things.
Right. And it's a cycle too. They call it the wage price inflation. When the labor market's tight and there's not many workers out there, then companies are forced to pay more money to get workers and climb the ladder. When all of a sudden there's people working out there, then people not working, and a lot of people have lost their jobs, then these companies that are hiring can get people for cheaper because people will be willing to take less if they don't have a job prior to that. So
Right.
it's also to break up. It's important to break up the labor market to avoid the wage price spiral, which is kind of what we're seeing in a couple of ways, like the Teamsters, the UPS, other people have bargained for very serious increases to match inflation. So inflation goes higher, workers demand more, then inflation goes higher because workers demand more, and you get caught in that spiral, and it's a bad place to be.
Before we go into these other assets, I'm going to be putting charts up when you ask for those assets, Jim. The ECI, which is the Employment Cost Index, from Q1 of 2020 is up 14%. So that means, in theory, whether it's benefits, wages, whatever it is, employees are getting paid 14% more. But since then, inflation is up 18%. So when you hear politicians crowing about how much inflation has dropped, remember, your wages have not gone up as much, which is why you're still feeling it, even though they're telling you you shouldn't feel it. What do you want to look at, Jimmy?
Can we look at Bitcoin?
Yeah, hell yeah.
That's a fun move was interesting.
I'm going to look at Bitcoin US dollar here in cash. Is that okay with you, or you want something
fine with me? Yeah.
Here's a daily. Let me stretch it out so it actually looks like a chart instead of a bunch of dots. All right, what do you want to look at?
No, I thought the move yesterday was interesting. So it was a 2-day move, up over 4%. Bitcoin has been very historically non-volatile. Just to put it in perspective, in 2021, the high to low of that year was $39,000 difference. The high to low in 2022 was a $33,000 high to low. In the last, since March here, it's only a 7,000 high to low. So there's not much volatility in Bitcoin right now.
Right.
You're drawing that, which is an interesting pennant, whatever you want to call that.
Yeah.
You think that it's hit the top and now reverses. Does today's? I thought the move was encouraging the 2 days prior. I didn't make a trade.
It is. I'm sorry, because in fairness, this is the actual channel.
Yeah.
So I suspect you're talking about the 2-day breakout. This is actually more the channel that it was kind of trading in.
Right.
I'm extending this a little. This is more of a best fit channel.
Yeah.
But I like Bitcoin for a couple of reasons. From a trading aspect, I want to stress this from a trading aspect. I'm not a hater of crypto in a general sense, but I'm a much bigger fan of gold as a store of value than I am of crypto right now. Larry Fink blessed it, right? I mean, Larry Fink from BlackRock applying for a Bitcoin ETF basically blessed it. So that basically is this move here.
That's what I thought. Yeah.
Yeah, right. It's this move here. And we kind of been sitting around waiting for Larry Fink and BlackRock's ETF to be approved. Now, keep in mind, BlackRock will make money off of anything BlackRock can make money off of. This doesn't mean that all of a sudden Larry Fink spoke to the people he needed to speak to, and they said they're going to let Bitcoin run. Okay, there still could be. This is my problem with Bitcoin, is it could be legislated out of existence tomorrow.
Yeah.
There'd be nothing anybody could do about it.
My opinion on Bitcoin, and I don't understand it fully as an asset. You know that scene in The Fugitive where Harrison Ford looks at Tommy Lee Jones and he says, "I didn't kill my wife." And Tommy Lee Jones looks back and says, "I don't care." And that's what people try to tell me about Bitcoin. But I'm looking at the price. I don't care. I think it's an interesting tradable thing. I do own Bitcoin, and I buy it into an account on a weekly basis. I have for a long time, a very small amount, because if these crazy Bitcoin holders are correct and it becomes the proxy for fiat currency because we're in some sort of cataclysmic currency crisis, write that down, cataclysmic currency crisis. That was a good one, I thought. So, but anyway, if that happens and all of a sudden it was like, shit, we were supposed to be long Bitcoin, I want to have some of that on the ledger. But as far as what it is and what it solves, Steph Pomboy talked about this on our podcast yesterday. I'm not certain of it, but a chart's a chart. And to me, that looks like a breakout, a retest, and perhaps it goes higher.
Totally agree. Part of my problem with Bitcoin is I have to get political to say why I might like it long term. So that to me is the issue, right?
Sure.
And we actually have a question on Bitcoin, so let's not move on until the question gets put up on the screen here.
Yeah, before the
By the
question
way,
comes up, I just said I don't know much about it.
yeah. No, I mean, I'll speak to this because I think this question is to me because I said I like gold over Bitcoin.
I do too.
And by the way, MM79 Max, you guys, thank you for we like this kind of stuff. So if questions come in more, we're happier. What do you think is the advantage of gold as a store of value over Bitcoin? Would you consider it to be better than gold if the regulatory specter was not an issue? So second part, first, yes. If regulatory concern was not an issue, then I think there would be no roadblocks to the conversion to fiat, which quite frankly is still what I go to the grocery store with. Now, I got corrected in a Twitter space once, which I guess now is an X space, that there's plenty of things you can buy directly with Bitcoin. I'm just old and I don't know where they are. So very recently, and I mentioned this in our podcast, so it's public knowledge, I sold some physical gold. Okay, I own physical gold. I have some in storage. In a place I won't tell you guys, some here at the house. Full disclosure, I own guns and I have a dog. I took some of those just because it's a process that I do, and I took a couple of coins and I sold them. I left my house at 11 and I had an envelope of cash and a cashier's check by 1. It's very easy to turn gold into something that I can take to a Target and buy tennis shoes with. Okay, it's not so easy with Bitcoin. Now it's a very clean, some cases expensive transaction. There's a lot I have to learn about using Bitcoin as fiat, using it as something I can actually spend. Here's the problem with Bitcoin disciples: they are not willing to teach people like me how to do it. In my experience,
okay.
Once they get willing and they stop going, okay, boomer, of which I'm technically not a boomer anyway. That ended in 1963. But at the end of the day, if you're not actually able to teach people how the adoption is simple and how you don't actually have to remember your key with your old brain to access the crypto from your wallet, those are the hurdles for Bitcoin to me. But the biggest one is the regulatory hurdle. So I think
I would say I would like to add something to that answer too, which I think is great. And again, those people can go to hell, and I agree with you. They're sometimes annoying, and when you ask them the questions, they call you boomer. But anyway, gold has a history, thousands of year history, but gold is also held and favored by sovereign wealth funds and central banks around the world, far, far more so than Bitcoin is at this point. And I know people point to El Salvador, which I'm not sure the macroeconomic conditions of El Salvador has that many ramifications for the globe, but gold is still bought, traded in. Gold is still a real thing. I mean, it's obviously harder storage costs than Bitcoin, but it's real. You want to cut it here, or got any more?
I want to throw one more thing up. No, I don't.
Good.
We're done. Yeah, let's cut it. Again, so for those of you that stuck it out for the full hour, we appreciate it. We start guests next week. We will not have a guest every week because they're harder and harder to get. And we speak to them for an hour on our podcast sometimes. So get them on here for 10 to 15 minutes. If there is a guest you want to see and you can either reach out to them or you want to send them our way and I'll try and reach out to them, feel free. We love doing this show. Next week, Jim O'Shaughnessy, who's a legend. And after that, Cameron Dawson is the following week, who's about the smartest person I think we know.
You guys are going to love her. She's the best.
She's up there. Quick question, last question up here from LJ, and then we'll cut it.
Good.
Let's see. I think accounting, it disappeared. I think accounting for crypto on your tax returns still needs to be made easier. Plus, the navigation through the crypto world still needs to be made simpler. Amen to that, Jimmy?
Double amen. It's 2 amens. By the way, in your tax returns, if you've never sold, this is a question for you, Bobby, and a question for anyone who wants to type in the answer. If you've never sold any crypto out of your physical crypto, and it's not, there's no taxable event, there's no capital gains, but there is still a place on your tax returns that says you're supposed to report it. What the hell business is it to them if it's not a taxable? It's kind of irritating, isn't it?
Well, I know that you and I are both against taxing the value of assets, right? I mean, way against taxing that your house goes up, you're supposed to pay taxes on that.
Yeah.
Yeah,
unrealized gains, right?
that's one of the things that makes me worry on the regulatory side, because if they actually put that through and say that you have to pay taxes on crypto that have appreciated, but you have not cashed out. Sorry, I'm on the show with this. Fuck you. That's wrong. Sorry. Bleep
Okay,
that out.
that's a bad way. Leave them with something good. Have a great day, guys. Disregard Bobby's awful vocabulary. Thank you guys so much. I appreciate all the questions, and contact us on Twitter. We love the conversation, and thank you. That's it.
See you next week.